So let's talk about what you're here to talk about, which is real estate. And right here we can see home ownership rates back in the 60s. Look at that, a lot of increase in home ownership and then decrease and then flat. And then in 95, it just starts to take off. And so there's a lot of reasons for that, but mostly more government incentive to own real estate, but also really important to understand that there was a generation there, the baby boomers. I'm going to take a sip of water. Baby boomers who at the time, let's see, I'm the youngest baby boomer. So in 82, Rich and I were around here, we were 18. So by 92, we were 28. So right around here, we were the youngest baby boomer. Now, the typical time that people buy their first home is at age 31. So what this possibly could be is, yes, government stimulus for sure, but also baby boomers. Anything they touched turned to gold. Whatever they were doing, if they were going to college, colleges boomed. When they bought their first home, well, the housing industry boomed. When they started investing in the stock market boomed. So this could be partially kind of a baby boomer thing. And then right around here, when homeownership rates declined, this is when baby boomers started retiring. And so, they're not buying as much. So, but also, of course, we had a major housing meltdown. So today, homeownership rates are the lowest they've been in 50 years. It's a 50-year low. And why? What's going on? So we'll talk about that in a minute. Here's mortgage interest rates. This is different from the Fed fund rate I mentioned earlier. And as I said, a lot of people are guessing. They don't really know, but they're saying things like, oh my gosh, if interest rates go up, it's going to affect housing. So I'm here to question that again and just show you charts that in the 80s, interest rates were above 19% at some point, but way high, way high. And yet the housing market was on a tear. So people were more than happy to pay 15% or even 19% interest rate, and they were still buying homes, and the housing market was booming. And that's because the economy was booming, so you could still afford, and home prices hadn't gotten so out of hand quite yet. So you could still afford that house payment even with a 15, 16, or 17% interest rate. And then you fast forward to the recession when interest rates went to historic lows. And that was like, hey, we need people to buy houses. Affordability was at its best. As I said to Robert Schiller, interest rates at their all-time lows, home prices at their all-time lows, but nobody was buying, or it was hard to get people to buy. And that was because, so many factors that, it was either they couldn't qualify, they had too much debt, or their FICO scores were just decimated. Whatever it was, interest rates were low, but housing hadn't taken off yet. Interest rates high and home prices rising. So I'm not really that concerned about interest rates. What matters is everything else. What causes people to buy houses and if they're able to qualify. So if the economy booms and interest rates go up, well, it won't really matter. But if the economy is not booming and interest rates go up, that is a problem. That's a big problem. And so again, we'll talk about that in a minute. But what I want to say to you is that if you can, I know Bruce Norris and several other housing experts are trying to work with Fannie and Freddie to get them to give more loans to investors. Again, we're going to talk about that in a minute. This is just a quick snapshot of existing home sales. So you can see big drop, and then we haven't really recovered yet in the number of home sales yet at the same time. So, not as much homes selling, but prices going up past 2006 bubble prices. So we're not at the sales number of 2006, but we're at the pricing of 2006. So, that says something. Prices up, but, people maybe can't afford to pay. Or can't get the loans. They might be able to afford the mortgage, but they can't qualify for the loan. I want to point out this little chart over here with the light blue lines. These are recessions. Recessions happen about every decade. You can see we haven't had one in this decade, and I'm just going to point that out for you to think about. So here we have housing starts. Look at this. Builders are like, yeah, look at this. We're just going to keep building. We're just going to keep making money. Just wow, housing never have a recession. You just can't lose until you lose everything. And this is, look at this. Builders just fell off a cliff and many of them lost everything they had gained in these years prior. Builders got just hammered. This was right about when Real Wealth Network started buying land and building, because we could partner with these savvy builders who couldn't get money and their credit had been shot and they lost everything, but they didn't lose their skill set. And so they were able to help us find really good deals and analyze those deals. And we just, with our investment group, would put up the money and be able to take a large share of the profit because we were helping builders get back in business. We're still doing that today. But you could see here, builders are nowhere near where they were and nowhere near where they need to be, which is somewhere around 1.5 million new structures to keep up with the growth. So this, again, is one of the reasons why there's not a lot of sales activity, or there's less sales activity, because there's just not very much inventory out there. And at the same time, U.S. home prices have moved past their peak. So not a lot of new homes, but the home prices are back to 2006 levels. And that is partly because it's become so expensive to build a home. Builder costs have gone up 30%. And so they're just not seeing the margins and the profits that they used to see. So it's just, and they're, freaked out about doing it wrong again. So we're just kind of nowhere near back where we need to be in new homes, which has caused a lack of inventory, which will continue to have home prices drive up, while at the same time, our population is growing. So let's take a look at, there's actually a slide I'd like to show after this, but I just want to quickly show this. Types of households. Renter occupied, there are 43 million households. And within those households, there's 111 million residents. And owner occupied is 74 million, with double the residents in the owner occupied. All right. And the age distribution, you can see under 30 years old is 9 million in the renter occupied households and 2.9 in the owner. And then you've got a huge chunk there in the 30 to 44-year-olds of renters and homeowners, about equal. And then as you get older, you see way more homeowners than renters. And then in the 65 and older, again, way more older people who own their own home. Thankfully, that's good. That's where you want to be, 65 or older, in a home that you own, free and clear, hopefully. All right, and tenure by age of population. So under 30, again, 55 million people in rental housing under the age of 30. So let's take a little closer look at the rental profile for those. I'm kind of speaking to those of you who like real estate and like cash flow and want to own rental homes. 43 million rental renter households exist today. 43 million, and 15%. Only 15% have more than $10,000 in savings. So out of these 43 million renter households, and I'm talking about households, not just individuals. Individuals is like double that. But the households, so several people living together, have over $10,000 in savings. 15%. And oddly, same number, 15% of loans were under a 700 FICO score. So basically 85% of loans made were over 700 FICO. 40% of FHA loans had a 680 credit score. So, and then we know that many of these renters are suffering from major debt and not great credit. So when you add all this together, it is believed that only about 3% of renters today could actually qualify for a loan. Isn't that amazing? So that's a problem. We've got 43 million renter households, and only 3% could potentially become homeowners. All right. I want to look at demographics real quick to understand who are these people, these 43 million rental households, and beyond that, double that in individuals renting. What we do know is that the millennials have overtaken the baby boomers. Last year, there's 75 million millennials ages 18 to 34. and growing because of immigration. And the baby boomers, who have been the largest generation, are now declining because they're getting old and dying. So you can see a pretty, let's see, 75 to 65, a $10 million loss of baby boomers. 10 million baby boomers are going to kick the bucket in the next 10 years. So if you're a baby boomer, I suggest you eat healthy and take your vitamins and exercise. So you're not one of the 10 million that are not going to be here. But it's, you see then it really accelerates after that. And then right about that time, Gen Xers will have overcome the size of the baby boomers. So why this matters is that when you've got a large population, it has a massive effect on the economy. And so, like I said, when housing took off, that's when baby boomers started to buy houses, but now they're not. So who's going to take their place? And our millennials, well, they're saddled, as you saw, with student loan debt, and only 3% could potentially qualify. So the bottom line is millennials will be driving 2/3 of household growth over the next 10 years. There'll be twice the number of household formations than in the last 10 years. But mostly those household formations are going to be renters, not homeowners. So this leaves an amazing opportunity to buy investment property and rent it out for at least 10 years, because the largest age group within the millennials, the largest point is about age 24, 25. And so, they're just out of college. They're just getting their lives together. They're just getting jobs. They're probably not, normally you wouldn't buy your home until age 31. But they're a little bit delayed, so it could be age 32, 33, 34. So we're looking at a good 7 to 10 years of millennials renting, not owning, and so it just leaves an amazing opportunity for us to be the ones renting to them. Because, after all, we're baby boomers. We've been giving these kids money for a long time, so it's about time they gave us the money back. They could do that through rental property. But what kind? And so here's a slide to show you the demand. Back in the 70s, look at this. If you were an investor, you were basically investing in multifamily, and still it was the main trend. But then you can see the demand for single family housing really increased, and that's really simple to figure out why. Renters became homeowners just by signing a piece of paper, and oftentimes got cash back, so they went from an apartment to a single family home. And they weren't really in a big hurry to go back to an apartment. So many of the people who lost their homes, about, 8 million or so, between short sales and foreclosures, want to rent homes. And so you see a huge demand for single family rental homes as well as apartments. But apartments are hard to find these days, and the cap rates are really low, whereas, we're still finding properties that have double-digit returns. So we personally at Real Wealth Network think that single family rentals are the way to go. Now, this migration slide is fascinating. This is, the question is, where do I buy this rental? Where do I get the best deal? Where do I get the best yields? The red shows out migration, and the blue is in migration. And so look at California. A lot of people have felt, look at San Diego. I mean, they're leaving in droves. So what's happening? Why are people leaving? And it's obvious. It's too expensive in certain areas, so people are moving to less expensive areas. You could see the Northwest. A lot of people, it's typical California money going from California to the Northwest. They're also going to Florida and Texas, no state income tax states. They're going to Nevada and for no state income tax, and Arizona, just because it's warm and close and cheap and lower taxes. So Colorado, look at that, a lot of in-migration there, and little cities in the Midwest, the ones that are booming and have job growth. North Dakota, you can see a lot of in-migration there for oil. Georgia, yeah, so lots of shifting. And so it's really important to understand that there is a massive shift, happening. And if you think that what's happened over the last 40 years is what's going to happen over the next 40 years, you're probably wrong. It's all changing. And so you've got to be aware of that. If you think that California home prices are going to continue to rise at the pace they've been going, then I will challenge you on that. You're probably wrong. And the reason for that is that we have hit affordability levels, and I think that Bruce Norris is going to talk about this on Saturday as well at Think Realty, that affordability levels in California have hit 30%. Now, normally, you don't see a cap or a turnaround, a new market cycle until you get to about 17% affordability, but that's only been because of crazy loans. Banks are nowhere near interested in giving out. They have done no interest-only loans. They've done no stated income loans. It's been 30-year fixed rate loans to people with 700 credit scores, and they're not going below that 30% affordability, and it doesn't look like they're planning to. And so we've hit the max, we've hit the ceiling in California, and it's expected that we're just going to stay at that ceiling. It may or may not see a decline. I think we'll definitely see a decline in San Francisco because we're about 10-20% over affordability there, so there'll be likely an adjustment in that area. But in other parts of California, unless you're going inland, then you're probably not going to see appreciation. So you have to ask yourself, why would I own property there then? Am I cash flowing? It's usually to get appreciation. If you're not going to get that, then you better be cash flowing. I kind of doubt you're doing that unless you've got vacation property, like friends of mine who are rolling in the dough. They're making so much money on their vacation rental. So that's one option. All right, so I'm going to just quickly go over this bubble thing, and then I'm going to have to wrap up and tell you where the hot markets are and stuff at the live event, or you can reach out to us at Real Wealth Network. But what we do know is that Donald Trump said that we were in a big, fat, ugly bubble in September of 2016 and during his campaign. And now look at us, And so historically speaking, one would say, yeah, we're probably in a bubble. And then based on earnings and so forth, and the fact that when you really look at who's invested in the past year, it has not been investors. It's been mostly corporate buybacks, borrowing that cheap money from the Fed and buying back their own stock. So is it a bubble or not? That I'll let you determine. I'm cautious. And then this is another chart just kind of showing the same thing I showed with housing. When the baby boomers, this is 82, again, I was just graduating from high school, so the bulk of the baby boomers at this point were actually more like 28, 30. So they were just starting to invest in the stock market. And look at that, it's just taken off ever since. But here we are now with the bulk of baby boomers retiring by 10,000 a day. And so they're doing something very different than they've done over the last 82, 92, 40 years, I guess, right? Yeah, or whatever, 35 years. They're doing something very different, and that is they're taking money out. They're retiring. They're saving money. They're taking money out of the stock market, not investing. And so if they're doing that, who's going to take their place? Who's investing in their place? Their kids? No. So again, just be aware that the next 40 years are going to be very different from the last. So don't think that just what has been is what will be. You need to look at all this data, make up your mind what you think is the right and safe place for you. And what we think is the best strategy is getting out of high-priced markets like California, selling your investment property, unless, like you said, I have friends who have a house on the beach and they're just raking in the cash flow from Airbnb, but most people aren't. So, if you're not making cash flow, then exchange your high-priced property for low cash flow, for low-priced, high cash flow property in other markets. You have a chance to kind of time it, like I told you earlier, that we did in Dallas, helping people sell California property at the peak in 2006 and buy Texas property at the trough. So there are other parts of the country that haven't recovered totally yet, and they make for a great opportunity to jump in. Land development in growing markets, we're still working with builders because they can't get financing to provide more inventory because there is just a real lack of inventory out there. So that's been a huge profit center for us at Real Wealth Network. We do syndications where instead of any one of us going and putting $8 million down on some land and building it, we each put in $50,000, and I have my 40-year veteran developers developing the land and splitting the profits with our members. So that's syndications. Seller finance properties, I think that's going to be huge because so many of these renters, as I said, only 3% can qualify. So being able to lend to them could be just a really great business to do. Private lending. We have a private lending fund where our investors who want totally passive can just lend to flippers and share in the profits on that, and they don't have to do any work, the investor. And then flipping in the right markets, this is not my thing, but I know that people have made some pretty good money in the last few years. You just have to make sure you time it right. And you need to know, if you're flipping property, that you're probably entering a market where you can't rely on values just going up organically. So you better be buying the property cheap, and you better be doing it right, because you're not going to get lucky just on the property appreciating. It's just, we've hit a ceiling. So be careful. So where are the best yields? We really believe the judicial states are great because there's a backlog of foreclosures in those areas. Florida, Ohio, New Jersey, New York, Pennsylvania. These are areas where banks just haven't been able to foreclose because of their judicial foreclosure laws that have to go through the court system. So there's still a lot of distressed inventory and discounted property in those markets. Secondary and tertiary markets, this is where the foreign investors have gone. They've gone out of the primary markets of San Francisco, New York, Seattle, and so forth, and they're now investing in other markets like Orlando and Atlanta and Cleveland and so forth. So they're going to places where there's more yield, and that's where we're going to. Areas with city redevelopment. I'm going to be sharing all the markets that we think have the best yields at the live event. So hopefully, and it's also on our website at realwealthnetwork.com. And let's see, new home construction. Again, we want to be in areas where there's not more construction than job growth. It's got to be in line. And then, of course, areas with millennial and baby boomer appeal. Mostly millennial, because wherever the millennials end up, they're going to raise their families, and there's a good chance their parents, baby boomer parents, are going to want to move near them to be with the kids. And then low state income tax states, like I said, Florida, Texas, these are really good. Ohio has lower taxes. Nevada, that's why we're building in Reno. So lots of opportunity there, and landlord friendly states. So here's just a few of the cities. You can get lots of information on all of these cities at realwealthnetwork.com. If you're not a member yet, you can just text the word network to 72,000 to get more data on these cities. And you can also meet with an investment counselor. And then once you kind of put a plan together and decide where you want to invest, we would introduce you to a team in one of those markets who can help you find turnkey rental property that fits what you're looking for. Here's some case studies that I can't really go into in detail, but really I will be later, but just some examples of our members who've done great. This is my 10 property plan where you buy 10 rental homes. Oops, and this thing has just got a mind of its own. I don't know why. Hopefully it'll stay. All right. The target would be to buy a $100,000 home, so you could sell a $500,000 home in California or $1 million home in California and get 10 properties elsewhere. So now you're diversified from 1 to 10, and you're out of a high-risk earthquake place that's tenant friendly and so forth, and go to another area that is more landlord friendly and where you're diversified. So if you had one vacancy in your one property in California, you'd be 100% out of money. But if you had 50% vacancy on this 10 home portfolio, you would still have more money in cash flow than you would have even if your California property were rented out. So this is what we teach people, is to try to find homes that are around $100,000. It's getting really hard to do that because prices have gone up, but our teams across the country are still finding great deals for our members. And so then if your target is $300 a month net cash flow, you times it by 10 properties, you'd get $3,000 a month cash flow, or $36,000 a year. You would go to pay off house number one's loan, $80,000 loan, $100,000 house, $80,000 loan. You could have the first house paid off free and clear just from cash flow in a little over 2 years. So then you take all the cash flow, now that there's no loan on that property, and now you have more than 36,000 per year, you could pay off the second home, and then the third, and then the fourth. And within 12 to 13, 14 years, you'd have all 10 homes paid off. So $1 million portfolio with now probably about 70 or so $1,000, actually probably more like $100,000 a year cash flow. After expenses would be, like I said, probably closer to 70, 80,000 in 12 years or so when you've got all those loans paid off. Plus, that doesn't mention the tax benefits that you get and the appreciation, the increase in rents. I didn't even include that. Increase of rents or value in the property, and then asset protection. All right, so here's some examples of the syndications we've done. Really just amazing returns. We have a new crowdfunding site. It's called Real Wealth Crowd, and you can find out all about our syndications. We're going to be talking about one tomorrow at my live event in San Diego that is going to be amazing. I'm just blown away by this opportunity, and I'm excited to share it. We have the manager, or the developer of that coming tomorrow night. So I'll be giving more information on what I'm talking about today, plus our newest syndication tomorrow night. So I hope you can join us. All right, so that's how you find us. You can, The Real Wealth Show, or Real Estate News on iTunes. You just search, you get your little podcast thing and search Kathy Fettke, and you can sign up for my shows. You can sign up for Real Wealth Network and have access to our weekly webinars where we profile different parts of the country that we think are at the beginning of their boom cycle and fit what we look for in a good market to invest today. It's all free. Just join the network. You can go to realwealthnetwork.com or text network to 72,000. I've got my book, Retire Rich with Rentals, on Amazon. It'll also be at the event. I think at Think Realty they'll be giving out the electronic version of the book to those who attend. So definitely check that out. And let's see if there's any questions. I have literally no time. I'll take a couple questions. All right. Someone said Bernanke was corrupt. Yep, they all are, in my opinion. Someone said you're doing a great job. I'm completely open-minded. Yay! All right, Kathy, how will the national debt affect real estate investors? Wish I knew the answer to that. Let's put it this way. We know that when people defaulted on their mortgages, we had a international shakeup in the economy. But people who owned cash flow real estate in markets that weren't affected by that did fine, like Texas. So you want to be in areas. What we know is that people like to live indoors, right? They need housing. And so if you can get into affordable housing, I wouldn't buy anything but affordable housing today that cash flows in markets that have strong, solid job growth that isn't going to be affected by a massive potential fallout. So depending on what happens with that national debt, Trump may decide we're not going to pay it. I don't know the outcome of that is. I have somebody coming to our event tomorrow who's worked for the government, has an inside scoop. He's got some ideas on that, and we'll talk about it offline, but be careful because something is going to happen, and it's going to be pretty massive. And I think any kind of fallout would hit the high-priced markets more than it would affect little places in Texas and Ohio and stuff. Let's see. All right. 1031. Someone said 1031, 1030. Yeah, just exchange. Get the heck out. That's what I would do. Kathy, I have loan requests coming out of my ears from fix flippers. How can we do business? Yeah, be careful on fix and flipping because you just got to be careful. Values aren't going to just go up naturally. You got to do forced equity, meaning that you produce the equity because you bought so cheap and fixed up and are still under market. That's how you're going to win. What do you think? What do I think about the Las Vegas market? Its values have gone up. It's a very low income area. A lot of service industry workers and a lot of people that don't stay very long. So probably a lot of California retirees are going to move there, so there's going to be that side of it. So if you were to buy in Las Vegas, just be aware that you're not going to get the best cash flow, and you may or may not get appreciation. So you could or you could not, but I do believe more baby boomers will be moving there. So I would probably, if I were going to buy, just know that I'm probably not going to get cash flow, but there's a chance values will go up as baby boomers move there potentially. That's just my thoughts on it. Okay, well, thank you. Thank you all so much for being here. I look forward to hopefully seeing you either tomorrow or tonight or Saturday in San Diego. All right, take care and thank you. Bye-bye.